What's going on, news team? Welcome back to Strongman Personal Finance. I am Christopher Bell, author of Stop Being a Broke Loser. Buy me on Amazon. Buy my book, please. Welcome back. Today, we're going to explore the different investable funds that are inside the military and federal government's Thrift Savings Plan. Now, if you don't remember, the Thrift Savings Plan is basically the military and federal employees' 401k. And there are 5 individual mutual funds or index funds that you can invest in within it, or you can invest in a life cycle fund. So we're going to talk about each of these, all right? So the first fund we're going to talk about is the G Fund, the Government Securities Investment Fund. Now, the sad thing is that a lot of people, for most of their lives, put a lot of money in the G Fund. And all the G Fund is it's basically a treasury fund. It is securities offered by the federal government specifically to the Thrift Savings Plan. They're basically bonds. So if you are young and you are looking to grow your wealth, pretty significantly over your lifetime, you don't want a lot of money in the G Fund, or you don't want any at all. I don't have any money in the G Fund because the returns are extremely low. It will preserve your balance because you're basically almost getting a risk-free return from the federal government. But it's not a way to truly compound your wealth because it takes a lot of growth to really grow a small amount of money into a large amount of money by the time you retire. So if you're young and you're scared of stocks, you need to get over it, because if you put all your money in the G Fund because it's safe, you're not going to make crap. You're going to retire with not much money. So the payment of the G Fund principal and interest is guaranteed by the U.S. government. That means the U.S. government will always make the required payments. So if you put your money in the G Fund, you're going to get your guaranteed little return every month or every year. But you also have to worry about inflation, because inflation erodes the purchasing power of the dollar. So if you go down and you look at these returns and you're like, average annual returns, and you look at the 10 years, okay, it's made 2% on average every year. Now remember, you have to take your return, you take 72 and divide it by your return, and that's how long it takes you to double your money. So if you take 72 and you divide it by 2%, that's 36 years before you double your money. So even 2% is just not good. And when you factor in inflation, which is roughly 2 to 3% historically, you're really not making anything by investing in the G Fund. So is it the end of the world if you have some money in the G Fund as kind of like a stabilizer of your portfolio? No, it's not. And as you get older, maybe it's okay to put some money in there. But you don't want the vast majority of your portfolio or any of it at all in the G Fund when you're young, because you're missing out on a lot of potential growth that you could get in the stock market. But look at the total assets. $267 billion are on the G Fund. So there's a lot of freaking people in there, okay? Now we'll move on to the F Fund. The F Fund is the Fixed Income Index Investment Fund. So I did another video about this a while back. And basically what's in the F Fund is a bunch of U.S. agency bonds, and I believe maybe a little bit of corporate bonds. We can actually double check that here. But if you go down, it's a U.S. aggregate bond index. And once again, if you invest in bonds, they do pay you interest payments, and they're not taxable because they're inside the TSP. But you have to factor in the impact of inflation on those interest payments. Because if you're getting paid 4% interest, and inflation is 2%, your inflation adjusted return is only 2%. And that's not going to grow your wealth enough for you to retire. So what does this invest in? It tracks the Bloomberg Barclays U.S. Aggregate Bond Index, a broadly diversified index of the U.S. bond market. The index includes almost 12,000 notes and bonds. So it's highly diversified, but it's subject to interest rate risk, and it's very subject to inflation risk. So you don't want to put a lot of money into the F Fund, especially if you're young. Now, there's only 39 billion or 40 billion of assets in here. So if you look at it, people, I guess they prefer the G Fund because it's guaranteed by the government, because it has 267 billion as opposed to 40 billion. So I personally don't have much. I don't think I have any money in there. I don't, because I'm too young and I want to be able to take more risk and potentially have a lot more reward. So this is the F Fund. Not highly recommended until maybe you're way older or closer to retirement. Next, we have the C Fund. This is the Common Stock Index Investment Fund. Now, it's not very specific, but it's basically the S&P 500, which is the 500 largest stocks in the United States. And that composes roughly 80% of the entire US stock market when you account for the size of the companies. So when you buy the C Fund, you're basically buying roughly 80% of the US stock market, and you're buying its largest 500 companies. Is it a bad investment? Absolutely not. Because you go down and you look at the returns over the past 10 years, it's had a compounded annual return of 13.9%. And look at some of the holdings: Apple, Microsoft, Amazon, Facebook, Tesla, and a couple other big companies that you might recognize. And there's $251 billion in here. Now, when you're looking at these returns, you don't want to just necessarily throw all your money into the best historically performing fund, because returns fluctuate. Returns rotate between international, small cap, and large cap. So if a fund has done well, even over the past 10 years, you still want to diversify and cover as much as the world as possible. Because if you don't, you might buy into the C Fund when it's basically peaked for the next decade and lose a lot of potential gains. So yes, you can put part of your portfolio in the C Fund. There's nothing wrong with that. That's 80% of the US stock market. But there's other things you should invest in too. So let's move on and talk about the S Fund. So the S Fund is the Small Cap Stock Index Investment Fund, and it basically tracks the Dow Jones US Completion Stock Market Index. So you have the 500 biggest companies in the United States. They make up roughly 80% of the US stock market, and then the remaining 20% is here. So you're getting a lot of the smaller companies that make up 20% of the total market. And look, I mean, some of these you might recognize: Square, Uber, Zoom, Twilio. Now, the beauty of small cap funds is that because they're smaller, they're a lot more volatile. But you can also expect to potentially make more returns in the long run because you're accepting more risk. Now, you wouldn't accept more risk if you couldn't potentially make more returns. That's why the S Fund is not a bad place to put part of your portfolio in. Now, if you want to have a roughly total US stock market allocation, you want 80% roughly in the C Fund, and you want about 20% in the S Fund of your US portion. Now, that may be like kind of hard to understand. If you have trouble kind of allocating your portfolio, you can use an L fund, which I'll talk about, and that basically holds all of the stocks at market cap weights. But look at the annual returns, compounded 13%. So, like I said, that's past performance, but at least by buying the S Fund, you're diversifying more than just the S&P 500, which everybody tells you to invest in, okay? I personally own the S Fund. I think it's like 25% of my TSP allocation. And I like that because I'm more broadly diversified. And look, there's $92 billion of assets here. Now compare that to the C Fund, $251 billion. So where do you think a lot of people are throwing their money into? It looks like they're almost chasing performance. There's a lot of freaking money in the C Fund, where the S Fund has like a lot less. So that tells me that doesn't necessarily mean that a fund is overvalued, but you generally want to, kind of reallocate and invest in things that have not done well recently that have historically performed pretty well, because they're usually due for a reversal. All right. So this is the S Fund, basically the remaining stocks in the US stock market. Now we go to the I Fund, the International Stock Index Investment Fund. Now here's the thing about this one. Although you see international here, it's not actually every stock across the globe. They only invest in basically or you can only invest in the companies of our allies, basically. You can't invest in Russian companies, Chinese companies, and India. There's a couple big countries in here that are not accounted for. So if you go down and look, it tracks the Morgan Stanley, I think it's like East Asia and Far East Index. Now, you're going to be missing a lot of companies here, but you're still going to get a lot of international exposure. Now, look at the net assets, $58.9 billion. So there's not a lot of interest in the I Fund. And it's pretty obvious why, because if you look at the past 10 years, look at the compounded annual return, 5.87%. But here's the thing. If it's performed badly over the last 10 years, they might have more these companies in the index might have more attractive valuations because they've been unloved. People haven't really bought them. Performance has been bad. So just because it's only done 5.87% in the past 10 years doesn't mean you shouldn't put some of your portfolio in it, because you might be surprised the I fund might actually do better in the next 10 or 20 years. You don't know. You want exposure to the entire world. So, or as much of the world as you can in the TSP. So, I mean, you might recognize some of these companies: Nestle, Novartis, Unilever, SAP. I use that at work. And yeah, I mean, I own some of the I fund. I think it's like 30% of my portfolio. So you can either determine to split your portfolio between these 5 funds, or you can let them do it for you. And that's where the life cycle funds come in. Now, if you want to be as close to 100% stocks as you can, and you want to hold the world at market cap weights, you can go to the L2065 Fund. And it basically invests in all 5 funds. And as time goes on, it shifts from mostly stocks, and then it aggressively transitions into the G and F fund. So the L funds are very conservative, but if you want to own mostly stocks, you don't want to think about it, you can buy an L fund that's way out in the future because it's going to have basically all stocks. So if we go down, we can look at this target or this asset allocation. And there's only $1 billion, and that's cute. Now, if you look at this, almost 50% of this is in the C fund. That's the S&P 500. 15% is in the S fund, and almost 35% is in the I fund. Now, look how much is in bonds: 0.35 and 0.65. And they hold the world at market cap weights. I actually, did some research, and they're taking the size of each market and they're weighting the size of the market as they're represented based on the overall world. So you can basically buy almost like VT inside the TSP without some of the emerging markets by buying the L2065 Fund. Now, do you necessarily need to buy this? No, you don't. If you want some bonds, you want some bond exposure, you can get a 2045 fund. Look, more G fund, more F fund. But if you're young and you're an aggressive investor and you don't get freaked out by stock market fluctuations and you want to own as much as the world as you can in the TSP, just put it in a L2065 fund. And then as time goes on, if you don't want any bonds, once the L2070 fund comes out, you can just transfer it over and it just works itself out for you. Okay. It's a one-shot solution. So that's it in the thrift savings plan. Overall, it's a great place to put your money. You should be maxing out your TSP, or at least as much as you possibly can, because it's tax advantage if you're in the military or the federal government. There's a lot of things on here. You can pick your own portfolio, try to outsmart the market, or you could just buy an L2065 fund and you have all the stocks that you can possibly get in the TSP at market cap weights, and you can keep shifting it down as time goes on. So that's pretty much it for the TSP. Let me know if you have any questions. No? All right. Well, that's that. Like the video, subscribe, leave a comment. I answer anonymous emails, and I will give you a live video. And please buy my book, okay? I'm trying to retire off book sales, and I get like $2 every time you buy my book. So if I get, 2,000 people to buy my book every month, then I can retire off book sales, okay? Stop Being a Broke Loser by Christopher Bell. Hope you enjoyed the video, and I'm going to go make dinner. Talk to you later.